Welcome to my speaker series. My name is Erica Carey. I'm from Renewed Living, and we're going to kick off our series today with a two-part presentation from a team of financial advisors who work for a great company in Burnaby. And so the first presentation is going to cover their process and what it would be like to work with them one-on-one. And as well as they will be covering protection plans for life insurance, as well as critical illness and disability, as well as long-term care insurance, which is something that someone or most people often don't think about, which is really, really important. We think about, oh, we got to save for our retirement, but we're just thinking about, age 65 and, all in good health. But we never know what's around the corner and anything could change. And if you need long-term care, that can be very, very costly. So I think it's really important that people think about that kind of stuff. So please welcome Grace, Mary Jane, and Kim. And I think Kim's going to take it away.
Thank you very much. Yeah, thanks very much, Erica. Hello, everybody. My name is Kim. And I have been a financial professional for 2 years now. I first got into the industry because I started looking at my own retirement a couple of years ago, and I realized, hey, I was not prepared at all. Financially, I was not ready to retire. Mentally, yeah, let's take some time off and, surf the couch and maybe do some traveling. But financially, I was not ready. And so I really needed to look into, how to get to that point where I was going to be able to retire. Luckily, we've got it all straightened out, and hopefully in the next, not today or tomorrow I'm going to be retiring, but hopefully sometime in the next 5 to 10 years, I'll be ready to do that traveling. So next, I'd like to introduce Mary Jane to you. She's a great friend of mine. She is super hardworking. She's got 2 kids. And is doing a great job as a mama as she helps families across Canada and the US to get their finances in shape. So over to you, Mary Jane.
Thank you, Kim, for that very nice introduction. Hello, everyone. My name is Mary Jane. I was a healthcare worker before and been in the financial industry for more than 5 years now. So what brought me here into this industry is the crusade. Helping people, right? No families are left behind. And the financial education that people deserve to know, which I want to learn it for myself and teach others do the same. Okay, and the next person that I'm going to introduce to you is a person that's dear and near to my heart. She's my mentor and a friend, Grace Tan.
Awesome. Thank you, Mary Jane, for that kind introduction. My name is Grace Tan, and I've been a financial professional. This is going to be my 16th year. So I started really, really young. And one of the things that really drew me here was that I actually had no idea about finances. I was, I started working in the education field, and I found out that many families, not just myself and my family, we're not really taught. We're not taught in school, and they're not really sure. There's a lot of information out there, but they're not really sure where to start, and it's overwhelming. And that's what drew me here. I became very, very passionate about the education part. We have a platform that allows us to learn, and at the same time now be able to reach out to families and share what's possible for them. And so because of that, just being very, very excited of just how important it is to think about, what is it that you want? What are the goals? And, where is it that you're at right now? Because I think we plan for everything else, like weddings or birthdays, but we don't plan for the life part, right? Financial life. So I'm super excited that you're going to hear from my dear colleagues, and you're going to hear, a couple of concepts. Thank you, Erica, as well, for allowing us to be able to do this with you. And we're going to start with Kim.
Awesome. Thank you very much, Grace. So I'm going to talk just a little bit to start out what the process is like. What is it like to meet with us? Our first visit, we're going to sit down with you. We're going to go over some concepts. and just find out, what your goals are. What are your hopes and dreams for you and your family? It doesn't matter how old we are or what stage in life, we've all got questions about our finances, right? So let's sit down and talk about those. And then on our second visit, we're going to go into a little bit more detail about your goals and how you can achieve those. We're going to look at budgeting. I know a lot of people don't like to talk about money. It's a little kind of iffy, but like any good medical doctor, we need to look at the symptoms. We need to look at where you are right now before we can come up with a plan of action. So we're going to look into your budgeting, and then we'll do a financial needs analysis, which we will talk about a little bit later. And then on the third visit, we're going to return with your analysis and some options, some suggestions for you. And at that time, the client makes a decision. We at our company do not actually have any of our own products. So we market for the big banks, for the investment companies, the insurance companies, corporations that we've all heard of them. We know and trust them already. And, some of them have been around in Canada for more than 100 years. So we can offer, as I say, different options. And then the client is able to choose which one they feel works best for them. All right, so let's take a look at, it's not working. Let's take a look at our financial needs analysis and how that works. So the first thing that we're going to do, as I said, we're going to sit down with you and we're going to look at your cash flow. How much money do you have coming in? How much money do you have going out? And, what is the discrepancy there? Are you positive at the end of the month, or you got more months left, at the end of your money? We certainly don't want people to be in that position. Secondly, we're going to look at protection. We'll talk about protection a little bit, and what we mean there is insurance. So life insurance, disability, critical illness insurance. These insurances cover you, should for some reason you not be able to work, right? And you don't have your income coming in that you normally do. We want to make sure that that income is protected in case, something does happen to you, and let's make sure that your loved ones are okay. And then the next step, the third step, is debt management. This is a huge one, right? Everyone is always talking about how they want to get out of debt, right? It's all, number one New Year's resolution. And unfortunately, it's the number one New Year's resolution every year because we never get out of debt. So let's see what we can do to consolidate your debt, or, even potentially eliminate it altogether. And then the fourth step is an emergency fund. We recommend that everyone has between 3 to 6 months of money set aside for an emergency. So if you're making $5,000 a month, we're talking about $15,000 to $30,000 that you need to have set aside in your emergency fund. There's always something happening, right? The brakes go out on your car, and if you don't have an emergency fund, you're putting that on your credit card, and now you've got more debt. The laundry machine breaks down, the washing machine, we all need to wash our clothes. So again, we don't want that expense going onto a credit card. And especially the last year or two, we've all seen what's happened with wages, with jobs, right? People are losing hours, they're losing their jobs. And, they need to help, right? The government has had to help everyone out. So if you have an emergency fund, you can help yourself. You can be a little bit more dependent. And then the fifth step is asset accumulation. We want to make sure that your savings are earning more interest than the rate of inflation. So if you have your money sitting in a bank account, maybe you're getting a quarter, if you're lucky, 0.5% interest. The rate of reflation here in Canada is 3 to 4%. You're losing money every year. So we want to make sure that that's not happening. We want to put your money into some kind of a savings account that's going to be making you some money. And we can do that very conservatively and still be earning 6 to 10%. And then estate preservation. Unfortunately, we're all going to pass away at some point in time. And the government taxes your estate. So any of your assets get taxed. And we want to not totally eliminate those taxes, but let's reduce them, right? We all work really hard for our money. Let's keep it in our own pockets or in the pockets of those of our family. Next, we are going to talk about the X-curve concept of wealth and responsibility. And what this talks about basically is that as we are young and we are building our wealth, we have lots of responsibilities, right? We're getting married, we're buying houses and cars and having children, which is very expensive. So when we're young, we have less money, but lots of responsibility. And then the opposite happens as we're older, right? We have more money, hopefully, and less responsibilities, right? Our kids are moving out, we're becoming empty nesters, maybe we're downsizing. So those responsibilities are lessening. We're going to take a bit of a further look at this. As I say, when we're young, we're getting married, possibly buying a house, a car, and having children, right? And it's expensive here in Canada to live. So most of our families are relying on 2 incomes. Now, what is going to happen if, unfortunately, the family loses one of those incomes, right? Now they've got a single income family, but they've still got mostly all the same expenses, right? They still have to pay the mortgage. They're still paying for the car, or maybe they're paying for gasoline. And as we've talked about already, kids are expensive, right? So what is the single income person supposed to do now? You know, possibly they could sell the house, maybe they'll sell the car, but they still have the kids that are very expensive. And that is why when we are young, there is a great need for insurance, right? We need to protect that income. Now, as we get older, we start to think about retirement. So most of us are thinking of retiring at age 65, but you know, the average lifespan is 85. That is 20 years that you need to be financially responsible for yourself. You know, possibly you're relying on a government pension, maybe you're going to rely on an employer pension, but do you really know how much those pensions are going to give you? And is it going to be enough for you to sustain your lifestyle? Now, as I say, 20 years is quite a long time, and most of us estimate that we would like about $50,000 to $60,000 a year to live, you know, a decent lifestyle, maybe do some traveling, go visit the grandkids, go on the odd cruise, that kind of thing. But, you know, if you're looking at $50,000 or $60,000 for 20 years, that's $1 million to, you know, just over $1 million, $1.2 million. So where is that money going to come from? I don't know very many people who have $1 million. I suspect maybe some of my friends do, and they're just not telling me because they don't want me, you know, expecting a handout. But, you know, that's a lot of money. So let's see how we can make that work for us. Now, what does happen with a lot of our seniors is they get to about age 70 or 75, and they've run out of money. They've run out of money before they've run out of life. These are some of the seniors that we see working in, you know, McDonald's or Walmart. And you gotta believe that those seniors do not want to be working. They're working because they have to. They've run out of money. So that's why it is very important to make sure that we have, you know, a nice retirement fund so we don't have to worry about that. And also, as we age again, that's why we need investments, right? We need to invest our money properly so that it's growing for us. Now, I will pass it back over to my great friend, Mary Jane. She's going to talk a little bit about insurance.
Thank you. Thank you, Kim. Kim did a great job.
Yeah.
Yes. Yeah. So as what Kim mentioned earlier, right, the need for life insurance is very important because we need to protect our biggest asset. Okay? Us. Okay? Because sometimes when we ask people, what is their biggest asset? And they'll say maybe a house, right? A car, but really it's us, right? Our ability to earn income. And we believe in, you know, educating families on how to protect their income, protect their family assets, and making sure that they have the right kind, the right type, and the right amount of life insurance. So you might be wondering, why do we need life insurance? Okay, so the first one is to protect your family and your loved ones. So life insurance will replace your income, you know, to support your family and loved one who depends on you when you pass away. And the second one is to pay off debts and other expenses. This is to cover any outstanding debts like mortgage, right? Credit cards, car loans, and other expenses like funeral and burial costs. Because of course, we don't want our family to be, left with any extra financial burdens. And the third one is to leave an inheritance. So by getting a life insurance, you can, leave a significant amount of tax-free money, okay, to your loved one upon your death. And the fourth one is to add more financial security. So planning ahead and purchasing the right amount of insurance coverage give you the power to secure your family's financial future. Just like ensuring there's enough money for your kids' education, or maybe helping your kids to have their own home, right? And providing for the surviving spouse. And the last one is to bring peace of mind. As what Kim mentioned, we don't know when we pass away, right? But eventually, it will happen. We don't know if it will be tomorrow, the next day, or maybe 50 years from now. Of course, no amount of money can replace a person, right? But more than anything, life insurance can help provide protection for the uncertainties in life. It will bring you and your family peace of mind. And now we're going to, talk about how much insurance do we really need, right? Of course, you want all your responsibilities, to be covered when you're gone. And we have the formula that we use to calculate the proper coverage of insurance. So we call it the DIME method. Okay, so as you can see, D stands for debt, whatever outstanding debts you have, right? For example, car loans or credit card debts, right? And then income. And we do income times 10. Okay, why? Because it takes 10 years for your family to recover. So for example, if you are making 50,000 a year, right? Multiply that one by 10. So that's 500. Okay, 500,000. And if you have, for those people who have mortgage, right? We include that one too. And then the last one is E, education and final expense, right? If you have kids, right? Of course, you want a good financial future. You want them to, have that fund for their education, right? So if you have one kid, we usually do 100K, okay, for one child, and your final expense as well. So just to give you a quick example, if you have 20K debt, right, and you have and your income is 50, as what I've said, times 10, that's 500, so that's 520 already. And you have 200,000 mortgage, for example, right? So that's 720. And you have one kid, so that's 100, right? And your final expense is, 50K, so that's 150. Okay, so all in all, 720 plus 150. So that's 870 altogether. That's your proper coverage based on those data. Okay, so now, and if you have any questions, right, just feel free to reach us, okay, and we're going to sit down with you, okay. And now we're going to, talk about the different type of insurance, okay. So here we have term versus permanent. So for term insurance, it's temporary, right? Coverage is temporary, and it offers a level premium for a stated term, either 10 years, 20 years, or 30 years. And it's very cost effective. It's cheap in the beginning, okay? But when you renew, of course, the premium will go up. And most people cannot afford the renewal cost. And it does not build up cash value, just like, you're renting a house, right? So if you rent a house, you can't get any money that you put in when you live, isn't it? Yeah. And if you miss your premium after, 31 days, your policy will lapse. So make sure to just keep on paying. Don't miss your premium. Okay. And also, I just want to share that term insurance is also sold by the banks as mortgage life insurance. Okay. But banks got the payout and claims are not guaranteed. Okay. So now we're going to talk about the permanent insurance. So in here, of course, it offers a level premiums over a lifetime. The cost of insurance is averaged out and can be set up to be paid up with a certain amount of years, like 10 years or 20 years. And it has, cash value. So now we compare it to buying a house, right? So when you buy a house, when you own a house, you're building equity on it. Okay. And the cash value, you can use it for, premium holidays. So for example, if you got laid off from work, right? Of course, you're going to use your cash value to pay for your premium. And then you can also use your cash value later on as your retirement income and use money tax-free while you're alive. Isn't that amazing? Yeah. And it can also use for estate planning, right? For your final expense and tax-free benefit. Okay, it will pass it on to your beneficiary tax-free. Okay, offset taxes upon death, and it provides intergenerational wealth transfer. Of course, life insurance is considered as one of your biggest assets. Okay, that you can pass it on to your next generation. Okay, so that's it for my part, and Grace will continue onto the critical illness and disability insurance. Thank you, everyone.
Awesome. Thank you, Mary Jane. She did a great job, right? Let's give her a hand as well. Awesome. You guys are doing super awesome. All right. So next I want to cover the other health protections, right? Which is what we would consider living benefits. So this is benefits that you would receive while you are living. That's why they're called living benefits. Mary Jane did touch on that with life insurance, you're also able to benefit through some of those retirement income streams that you could also have for your life insurance. So it has that component as well. So I wanted to touch on kind of the differences between critical illness and disability. And one of the things really is that I think these things, so in the beginning, you might not just think it's important. And it's only when somebody that you know, somebody close to you, where it happens to them, then you realize how important it is, right? And right now, a dear friend is going through it. And so, and more than ever, realizing how important these protections are. And then I will touch on long-term care as well. And so what is critical illness coverage? So critical illness coverage is a lump sum tax-free payment if you are diagnosed with a specified covered illness. It covers 25 critical illness coverages, or you can get covered with 4 conditions. It kind of depends on your budget and at the same time, your health your health risk, right? In terms of which one you should get. So for example, cancer, heart attack, stroke, bypass surgery, all the big ones, right? And the coverage, of course, depends on your current health. So, so sometimes people think, oh, I'll do that later, right? Like, anybody here procrastinator, right? I know a lot, right? We procrastinate on a lot of things, but this definitely is something that I urge you not to procrastinate on, because the moment something happens, right, then you're no longer able to get that coverage, right? And so, so it depends on your health. And when are you healthiest? I'd like to think I'm healthiest now. Maybe I was healthiest like 10 years ago, but I want to say I'm healthiest now, right? And so there's also a return of premium option. So for those who get it when you're younger, there is an option for return of premium if you do not get any illness, and that's a great thing, because then you pretty much have saved, like, there's a forced savings plan. But if you are in more senior years, right, then perhaps you might not need that because you actually want the coverage. And ideally, what you want, in terms of coverage is like, if you were to get sick, like how much would you need? Would it be 50,000, 100,000, 150,000? So it still comes back to like how much would you need, for a couple of years where you're not able to work anymore, or you want coverage to cover certain things, right? So what else in regards to critical illness, what does that allow, to help you have that? And again, it's a tax-free benefit that goes to you. There's not a lot of things that's tax-free that's given to us, and this is one of those things. So replace any loss of income. I talked about that. Reduce any debt that may get built up while you're coping with your illness, right? If you don't have any savings, and getting to that, so it covers that. As well, the financial support that you may need if you are in rehabilitation. We want you to rehabilitate with dignity. We want you to rehabilitate without worrying about, not being able to, pay for the house or the bills or things like that. But on top of that, what if you need professional help, right? Help at home, or perhaps that you may need to be at a care facility, and that's not cheap to have, care 24 hours or for extended periods of time. As well, that there are certain things that, and I'm very thankful to live in Canada that we are covered for a lot of things in healthcare, and never have I been more grateful, especially this past year, to be here in Canada. And but at the same time, not everything is covered, right? So first, your bills aren't covered, but other kind of things that you might need, whether it's massage therapy or occupational therapy, ongoing therapies that you may need might not be covered by whatever health program that you have. So again, this is where critical illness coverage can come in. And so just a couple of things in terms of stats that even for me, I was really surprised. And this was in 2010, according to Government of Canada, that the lifetime probability, and to me, this is scary, right, of developing cancer in Canada. And I would say that we live in a pretty, like higher standard quality of living. It's 1 in 2 for males in their lifetime to get cancer. And it's 1 in 2.2 for females. So that's, I would say that's very high, right? And yeah, so then therefore it's important to put certain protections in place for this in case this happens. Some of the statistics I talked about, the 1 in 2 develop cancer in their lifetime. Every 10 minutes, someone in Canada has a stroke. And 75% of those who have a stroke live with some impairment or disability, and therefore would need support at home, right? Either at home or again, if they would need to be in a medical care facility or long-term care facility. These are the most frequently claimed illnesses. 60% are cancer, 18% is heart attack, 7% neurological, 7% other, and 6% stroke. So these are your top ones, right? So, it's interesting to kind of know what does that look like. And this is, a source from the Individual Insurance Survey in 2016. So what about disability insurance? How does that differ from critical illness, right? Well, disability insurance actually, that's not what we want. Disability insurance actually pays a monthly benefit if an accident or illness causes you to be unable to work or earn income, right? So instead of, like with critical illness, there's 25 conditions that you have to qualify for, right? Here, there's no basically anything that prevents you from working will be included except for exclusions such as act of war, suicide, or pregnancy, or other kind of health exclusions at the time that you apply. Otherwise, anything that prevents you from working, you will get coverage with disability. So certain things like mental illness or burnout is covered. So I think disability gives a wider range of coverage. Seeing things like, for example, carpal tunnel, like syndrome, where it's a more soft tissue and it's not going to, it pains you, so you're not able to do your work. So that's there. So this can be short-term or long-term, and typically it's about 60 to 70% of your income. So if you are in your senior years and still continuing to work, that's kind of like a high, it's like a sensitive time. There's a higher probability of getting disability. So it's quite important to have that, okay? And so these are just some stats, because I think it's just interesting to know that 1 in 3 working age Canadians will become disabled and unable to work before they turn 65. So that's here. And what kind of most common forms is 31% is mental disorders. So things that we don't see, right? And I think that is important, that is covered under disability. 28% is other, 16% is cancer, 12% is cardiovascular diseases, and 8% is injuries. So it's quite interesting because most people would think it was injury first, right? But it's actually not. The other thing that I wanted to talk about is what, if the biggest thing is needing the in-home help, right? And so 60% of disabled people need help with daily activities such as walking, cooking, cleaning, personal hygiene. And that's really, again, needing help in that area. So you still need income coming in, right? And of course, there's always family to support, but then they need to work as well. So to provide, right? So needing professional help to come in. So needing income for those things is very important. So what is long-term care insurance? How is that different? In this case, it's a coverage that basically allows for you to get some benefit when you do become getting like critical ill or being totally disabled. And it kind of comes in 2 types, because it covers your stay in care facilities, right? So either it reimburses your expenses that are like outlined in your plan, or it gives you a set income addition in a predetermined monthly benefit amount, right? So, it could be what, $100 a day or $200 a day stay, like in terms of what you be covered for. So for us, we have one with one provider where their disability program can turn into long-term care. So I thought that's a nice kind of thing to go together. And so, with these things, in terms of just what we wanted to share, and thank you for your time, is that if any of the things that we said, like spoke to you, or you're like, yeah, maybe that I'd love to learn more about that, about proper protection, about critical illness, disability, or what does long-term care look like, or wanting a free financial checkup, please reach out to us, reach out to Carrie. She knows us as well. We're more than happy to give the education support you need and take it step by step, because it's all about just learning more and asking more questions, and then therefore you can have the peace of mind of like preparation. So So at this time, I wanted to thank Erica for, again, doing these series, and we're excited what part 2 would look like. Yeah, and just if you have any comments or questions, please, type it in, and then we'll find a way to figure out how to reach you and also answer any of your questions. So on behalf of my wonderful colleagues, which they've done a great job. Yay!
Yes, thank you so much.
Our first time. We want to say thank you for your time.
Bye-bye. Thank you.